If you have had a baby in the last year, or if you're planning to add to your family anytime soon, you need to stop what you are doing and listen. Uncle Sam and corporate America might have just signed a massive check for your kid's retirement.
It sounds a little like a late-night infomercial, doesn't it? Free money.
Exactly.
But for once, the free money isn't a scam. It's federal law.
Welcome back to the Deep Dive. Today is Wednesday, January 28, 2026, and honestly, the financial news cycle is just absolutely exploding. We are looking at a stack of sources today that paints a pretty wild picture of what folks are calling the gold rush for Gen Alpha.
It really is a gold rush. I mean, the big headline dropping today is that Bank of America and JPMorgan Chase,
The two heavyweights And it is not just the big banks. We're seeing a massive wave of companies jumping in. We have everything from, tech giants like Intel and Coinbase to everyday spots like Steak and Shake during the party.
Right. And this is all cascading from the One Big Beautiful Bill Act, or OBBBA, which passed last summer. Specifically, we're looking at the Working Families Tax Cuts section. The goal here is, well, it's pretty ambitious. It's to give every single American child a capitalistic head start the moment they're born.
So our mission today is simple. We're going to unpack exactly what these accounts are, how you can stack all this cash that's hitting the table right now, because it is coming from multiple directions, and the strict rules you need to follow to keep the IRS happy, because let's be honest, the IRS is never truly happy.
They certainly have their moments. But this program is fascinating because it's trying to solve a structural problem. We talk about constantly wealth inequality and, the lack of savings.
Okay, let's get into the mechanics. When we say Trump account, what are we actually talking about? Is this a savings account, a trust fund? What is the vehicle?
So think of it as a government-funded investment account. It's designed to build assets right from birth. Technically, under the tax code, it's a Section 530A account. If you want to get nerdy, it's a tax-advantaged custodial account.
And who is eligible? Is this universal?
The eligibility is, it's tight. And this is where, some listeners might get a little frustrated. It's for babies born between January 1st, 2025 and December 31st, 2028. This is what the Treasury is calling the pilot program.
So if you have a 5-year-old, you're out of luck.
For the government seed money, yes, you're out. The child has to be a U.S. citizen and must have a Social Security number.
So if you fit that criteria, let's say you had a baby last week, the U.S. Treasury just drops $1,000 into an account for the kid.
Yes, but here is the nuance that parents need to hear, and this is where people will mess up. It is not automatic. The money is allocated, but you have to claim it. You have to file IRS Form 4547 or use a new online portal that's supposed to launch this summer, around July 2026. If you don't file, you don't get the seed money.
That is a critical detail. You have to opt in to the American dream here. Now, once the money is in there, let's talk liquidity. Can I use it to buy diapers or pay for daycare?
Absolutely not. This is a lockbox. The money is locked away until the child turns 18. It operates very much like a restricted IRA. The whole idea is to let compound interest work its magic for nearly 2 decades without any one parent or child touching it.
And then at 18?
It transforms. It effectively becomes a traditional IRA. The growth is tax-deferred.
I was reading through the notes from Americans for Tax Reform, which is a conservative advocacy group, and they're framing this in a really interesting way. They aren't calling it a handout. They call it democratizing finance. Why make that distinction?
Because language matters in policy, right? The core philosophy here isn't welfare, it's ownership. The conservative economic view is that you want every American to have a stake in the game. You want them to be shareholders in the U.S. economy from day one. By giving a working-class kid $1,000 at birth and locking it into the market, you are turning them into an investor. You are teaching them, and their parents, about the power of long-term growth.
It attempts to shift the mindset from just being an earner to being an owner. And speaking of owners, let's get into the part that is making headlines today. This isn't just the government putting up cash. Corporate America is matching it. This feels coordinated.
It is. This is where the stack strategy comes in. If you are a savvy parent, you need to pay attention to who you work for, because your benefits package just got a lot more interesting.
We mentioned Bank of America and JPMorgan Chase.
Right. Bank of America is covering all 165,000 of their U.S. employees. If you work there and have a baby in that window, they match the government's $1,000 with another $1,000.
That is huge. And the list is getting long. We have Charles Schwab, BlackRock, SoFi, Robinhood. I mean, it makes sense for the finance companies. They want people invested. But what surprised me was Stake Inshake.
That one stood out to me too. State Inshake pledged to match $1,000 for every child of an employee. That is so significant because those aren't necessarily investment bankers earning six figures. Those are service industry jobs. That $1,000 match isn't just a nice perk. For a family living paycheck to paycheck, that is a massive injection of future capital.
It really is. It's essentially a bonus that goes straight to the next generation. And then you have the tech sector. Intel is in, Coinbase is in.
Coinbase is a funny one. Their CEO, Brian Armstrong, came out and said he wants to pay the match in Bitcoin.
Of course he does. That is very on brand.
But we will get to why that is a regulatory headache in a minute. The point is, the private sector is treating this as a massive employee push. They see it as a retention tool. Stay with us, and we secure your kid's future.
And it's not just companies. We have billionaires throwing cash at this, too. This is where the numbers start getting a little blurry for me. Who are the big players here?
We have some heavy hitters. Michael and Susan Dell pledged over $6 billion. They're giving $250 to 25 million children. And interestingly, they're targeting kids who might be a little older, up to age 10, not just the newborns. So they are filling that gap we mentioned earlier.
That helps the families who miss the 2025 cutoff. That is a crucial bridge. And Ray Dalio, the hedge fund legend, is doing something similar.
Yes, in Connecticut. He's matching the Dell pledge for families making under $150,000. Even Nicki Minaj pledged a few $100,000.
It's a cultural phenomenon when you have hedge fund managers and Nicki Minaj on the same donor list. But let's just look at the math. If you get the Treasury's $1,000 and your employer matches $1,000 and you qualify for a philanthropist's $250, your baby has a portfolio of $2,250 before they can even crawl.
That is a serious head start. If that sits there for 60 years compounding at an average market rate, I mean, that is real retirement security. We are talking hundreds of thousands of dollars potentially.
But, and there is always a but, there are rules. You can't just take this money and bet it all on the next hot meme stock, can you? I assume the government doesn't want tax dollars going into Dogecoin.
No. The rules are very strict, and honestly, they're designed to protect people from themselves. The legislation, OBBBA, has what we call the S&P 500 rule.
Break that down.
The funds in a Trump account must track broad U.S. equity indexes. You cannot buy individual stocks. Right. So no gambling on GameStop, no picking the next NVIDIA, no trying to time the market. You are buying the entire American economy.
So that means Coinbase
Cannot contribute in Bitcoin. Not yet, anyway. The law says U.S. equity index funds. Crypto is considered an alternative asset, and those are explicitly banned in these accounts.
That is pretty funny. The CEO wants to give Bitcoin, but the law says no, buy the S&P 500.
It's a safety guardrail. They also cap the fees. The annual fees on these funds cannot exceed 0.1%. That is 10 basis points.
That is incredibly low. Why that specific number?
It forces these accounts into low-cost passive investing. They don't want Wall Street eating up the kids' money in management fees. Yeah. If you have a fund charging 1%, over 60 years, that eats up a huge chunk of the wealth. At 0.1%, it's virtually free. It is actually a very conservative, efficient way to build wealth.
Okay, so we have the seed money. What about adding more? Can parents contribute, or is it just a one-time drop?
Parents can contribute. The total annual cap from all sources, government, employer, parents, grandma, is $5,000 per year. That cap adjusts for inflation starting after 2028.
And there's a tax perk for the parents too, right? Or at least for the employer's contribution.
This is Section 128 of the tax code. This is a big deal for the middle class. If your employer contributes up to $2,500 annually to your kid's Trump account, that money is tax-free. It does not count toward your gross income.
So it's like a 401k match, but for your baby.
Exactly. It's a non-taxable benefit. That's why companies are jumping on it. It is a very tax-efficient way to give their employees a raise without increasing their payroll tax burden significantly.
Okay, so I know what some listeners are thinking. I already have a 529 plan for college. Why do I need this? How does a Trump account stack up against the old guard?
This is the most common question I see. The distinction is purpose. A 529 plan is primarily for education. If you use it for tuition, the withdrawals are tax-free. That is the gold standard for college savings.
Right, because with the Trump account, you pay taxes on the withdrawal later.
Correct. A Trump account is for life and retirement. It grows tax-deferred, but when you take the money out after 18, it's taxed as income, just like a traditional IRA.
So don't use the Trump account for college.
Well, you can. The penalty for early withdrawal is waived for education expenses, but you still pay taxes on the gains. A 529 is mathematically better for tuition because those gains come out tax-free. But the Trump account has a different superpower. It doesn't require the kid to work.
Explain that.
Think about a Roth IRA. A lot of parents want to open a Roth for their kid because it's a great vehicle. But to open a Roth, the kid usually needs earned income.
Yeah.
You can't just dump money in unless the kid has a modeling gig or mows lawns and files a tax return.
A 6-month-old baby can't have a job.
Exactly. A Trump account has no earned income requirement. Parents, grandparents, employers can fund it from birth. That bridges the gap until the kid is old enough to work.
So the expert take is do both.
If you can, absolutely layer them. The 529 gets them through college debt-free. The Trump account sits there, compounding until they're 60, acting as a massive wealth transfer vehicle. It's creating a safety net that follows them their whole life.
I like that visual. One is for the degree, the other is for the nest egg. But we have to talk about the friction points because nothing involving the government is ever totally smooth, and I'm sensing some hurdles here.
True. The biggest friction point right now is simply bureaucracy. The accounts are legal, the law is passed, but the actual portal to claim the money isn't live yet.
Summer 2026, right?
That's the target. And contributions, the actual movement of money, can't physically start until July 4, 2026.
Very symbolic. Independence Day.
Very on brand for this legislation. But it means there is a waiting period. And for employers, there is some confusion. I was reading a legal brief from Lathrop GPM, and they pointed out that the Department of Labor hasn't fully clarified if these accounts fall under EISA rules.
ERISA is the law that governs employee benefits, right? Why does that matter here?
It matters for liability and fairness. ERISA has strict non-discrimination rules. Basically, a company can't just give these matching funds to the executive's kids. If they offer the match, they have to treat lower-paid employees fairly. It has to be broad-based.
Which goes back to the Steak and Shake example. They can't just give it to the corporate office. They have to offer it to the fry cooks, too.
Correct. If they don't, they lose a tax deduction.
Yeah.
So it forces the benefit down the ladder. And there is one more constraint that conservatives really pushed for, the anti-woke investing limit.
How does that work in practice?
By mandating broad U.S. equity indexes like the S&P 500, the law effectively bans sector-specific funds. You can't put this money into a strictly green energy fund or a specific ESG fund. You have to buy the whole market.
So you are buying oil companies, tech companies, retailers, everything.
You are buying the American economy, warts and all. The argument is that this protects the returns from political agendas. It keeps the focus strictly on financial growth. But for parents who want their investments to align with specific values, say they don't want to invest in fossil fuels, this account doesn't give them that choice.
That's a significant trade-off. You get the free money, but you lose control over the ethical composition of the portfolio.
Exactly. Take it or leave it.
So let's get practical for a second. We talked about the Form 4547. Is this something I can do on TurboTax?
Eventually, yes.
Hmm.
But since the portal launches in summer 2026, for this specific tax year, you might need to be proactive. If your baby was born in early 2025, you are already eligible. You don't want to wait until the last minute.
And what about grandparents? You mentioned they can contribute. How does that work? Do they just write a check to the kid?
Not exactly. Once the account is established, which the parent has to do, anyone can contribute to it, up to that $5,000 annual cap. But the control remains with the custodian, usually the parent. So grandma can send $500 to the account, but she can't decide how it's invested. That is locked by the statute.
It effectively simplifies estate planning for regular families, too. Instead of setting up a complex trust, you just max out the Trump account.
It acts as a poor man's trust fund. And I don't mean that in a derogatory way. It simplifies the vehicle, so you don't need a lawyer to set it up. It democratizes the tools of wealth, not just the money.
What happens if the parents never tell the kid about it?
That is the beauty of the system. The IRS knows. When the kid turns 18, the restrictions lift. The account doesn't disappear. It is tied to their Social Security number. So even if the parents are terrible with money, or they forget, or they just never mention it, that money is legally the child's property. The parents cannot raid it.
That lockbox feature is probably the most important part of this whole bill.
It prevents the piggy bank raid. We see that a lot with other types of accounts where parents hit a hard time and drain the kid's savings. With Section 530A, that is illegal.
So what does this all mean for the listener right now? If you are sitting there with a newborn or expecting one, what is the checklist?
First, get that Social Security number, ASA. You cannot play the game without it, and the SSA is going to be swamped.
Second.
Check your employee handbook. Go to your HR portal.
Right.
If you work for Bank of America, Intel, Charter Communications, or any of these companies we listed, you need to know how to trigger that match. Don't assume HR will do it for you. You need to raise your hand.
Because leaving that money on the table is crazy.
It is literally throwing away thousands of dollars of future wealth. And prepare for the stack. Be ready to file that form in the summer, talk to the grandparents, get everyone on the same page.
It is a wild time. We are effectively giving every American child a shareholder stake in the U.S. economy at birth. It's a massive experiment.
It really is. We have never tried something of this scale before.
It brings up a final provocative thought for me. If this pilot works, and if Congress extends it past 2028, does this effectively end the concept of a zero net worth generation? Or are we just creating a new headache for the IRS to track 300 million tiny portfolios?
That is the big question. But if it works, 20 years from now, we might be looking at the most financially secure generation in American history. And that changes the entire economy. It changes how people vote, how they work, and how they live.
And that is something worth diving into. Thanks for listening. Go check your HR benefits portal right now.
See you next time.